So let's just start with the first one. Section 180 of the Internal Revenue Code provides a current deduction for the soil nutrient value to land used in farming and owned by taxpayers who are actually actively engaged in farming. So the first category we're going to start with, take a quick look at, is farmers who are farming farmland or grazing ranch land. So that's 180. And so that's a fairly simple in a box. But Zach, let's dig in for a minute on a couple of key definitions. You got to be a farmer, okay? And distinguish the farmer from somebody who owns farmland who's not a farmer.
Sure. So Section 180, out of the four sections that we see people use here, has the most stringent criteria to qualify for it. But in return for meeting those criteria, you can take 100% of the deduction in that year, whereas the other three sections do require you to spread that deduction out over a number of years for more flexibility.
And when you say in that year, in the year of purchase and or inheritance, which is a very interesting concept.
Correct. So the definition, the criteria that you need to meet in order to use Section 180, in order to achieve that most accelerated use of the deduction, or you have to have filed your tax paperwork on a timely basis, and you as the landowner need to meet the IRS's definition of being actively engaged in the business of farming or ranching. Now, if you are the farmer or the rancher and the landowner yourself, that is absolutely, something that meets that criteria. However, there are additional ways that as a landowner, you can interact with a tenant and still meet those actively engaged criteria in order to qualify for Section 180. And that's a discussion that landowners will have with their CPAs to figure out, if they are not farmer or rancher themselves, what they may need to do in terms of how they structure their arrangement with that subcontractor or with their tenant in order to try to meet that definition.
And we're going to carve out a specific set of questions for the leasing. So I'm glad you've already kind of planted that flag for us to come back to. So Treasury Reg Section 1.175-3 gets into the definition of in the business of farming. And so that generally deals with the person who's making most of their income from the farming activity. So which means, which is interesting, that the person has to be farming to make a profit. And a lot of us maybe kind of farmers close to the metropolitan areas, such as myself, we don't farm necessarily for a profit. Well, we might, but we don't hardly ever get there. So 180, which is the most immediately beneficial tool, is really a farmer farming farmland. Talk about just for a second, the definition under 180 talks about land that is used in farming. I just want to ask a couple questions. We all think of that as row crops, okay? I mean, that's the first thing, wheat, corn, etc. But talk about a little bit about livestock, and then a little bit about your experience in California, where there's lots of, nuts and different fruits and different products that also benefit from this.
Yeah, we operate in every single one of the lower 48 states at this point. You can imagine the variety of uses of agricultural land that we encounter, across this country. High value things from strawberries to, pistachios to avocados, citrus, apples, pears, all the way down to your forages, managed pasture, grazing land, things of that nature. These are all agricultural uses of agricultural land. So land that is in an agricultural use It is not a hobby, right? As you were just mentioning, but you are actively trying to make a profit as an enterprise, conducting some sort of agricultural activity, regardless of crop type, is something that we can help people with.